Eric Robertsen is Global Head of Research, Stanchart, joining us live down Sydney side. Eric, good to see you again.
Thanks.
You know, the scare from the Fed and the dot plots, at least 2023. Now Bullard says, oh, hang on, I'm in the 2022 camp. That's next year. We're seeing dollar just spike. You don't think this is going to last, though?
No, I don't, Marty. I mean, look, there's a couple of things that have happened. Number one, the market on the rate side has shifted its focus away from long-term interest rates and tapering to the front end of the yield curve and the timing of rate hikes. Now, in terms of the dollar, for the dollar to keep rallying, I think you have to believe that the Fed is raising rates in isolation. And the reason we're still subscribing to the view of dollar weakness over time is that there are a number of central banks around the world, both in developed and emerging markets, that are also looking to raise rates, and in many cases before the Fed. And so I don't think it's fair to say that the dollar should rally because the Fed is going to be out in front of the rest of the world. I think what has happened over the last couple of days is a realization that the Fed's timing is a little earlier than people had assumed. So I think this is a short-term FX reaction.
Wow, would that include where you are, RBA? Because, I mean, labor market is red hot there, so is housing.
Yeah, look, that's right, Marty. We have the view that the Australian dollar is still cheap relative to its underlying fundamentals. We would agree with your statement that the domestic economy looks very strong. The commodity markets, in spite of the recent correction, are also still extremely resilient. And so I think the RBA looks to be one of those central banks that, while they're maintaining a dovish stance at the moment, I think over the next, let's call it 6 months, you'll see that stance start to shift quite a bit.
So, you know, we could talk about Europe as well at some stage, but I'm curious. I mean, this whole rest of the world and what they do argument, when you take a look at, let's say, ex-Australia, you've got whole swathes, big swathes of this part of the world. India is a problem. Inflation as well as the coronavirus. Much of Southeast Asia as well. Isn't that going to hold things back?
Well, look, I think you make a couple of good points there, Marty. Number one, the economic recovery globally remains noisy. It remains uneven. That's no surprise to anyone. But in terms of the net direction of travel, yes, there are pockets of weakness and pockets of challenges. We've argued that across Asia, you have economies like China, like Korea, like Taiwan doing very well. The other thing that's interesting is even with the COVID challenges, and I'm not making less of them, but the economic impact has been less this time around than it was, say, a year ago. And that's because we're seeing restrictions put in place as opposed to full economic lockdowns. And we do expect that as we get into the third and the fourth quarter of this year, that a number of these economies, which are highly leveraged to global trade, will start to do very well. Places like Singapore, Malaysia, and Indonesia.
So, because of your dollar view that the strength will not continue, at least not for long, and it will start to fade, you're liking gold beyond 1900?
Yeah, we still do, Marty, and I'll tell you why. There is an element of dollar weakness built into that. But for us, the most important driver of gold prices is real interest rates or inflation-adjusted interest rates. And in the United States, 10-year Treasury yields in real terms are still minus 80 basis points. They've had a mild increase, if you will, since the FOMC meeting, but across the curve, real yields remain deeply in negative territory, and we expect that to continue. And so I think as we get into the end of the year, we would argue that precious metals, including gold, should continue to trade well and would recover from current prices.
Wow, and that's why, I mean, you're constructive on commodities broadly, right?
That's right. And look, that's as much a stimulus story as it is a broader recovery story. If you take oil, we think we're getting into a period now over the next few months of sort of what we would call peak fundamental strength. We do expect that to dissipate into the end of the year and into next year, where Brent prices might trade back down into the 60s. But in the short term, Oil looks very strong for us, especially as we approach a recovery in international travel. Industrial metals continue to benefit from a recovery in global trade and manufacturing. So again, in spite of the short-term wobbles in reaction to the Fed, I still think a number of these markets will benefit from their underlying economic fundamentals.
Eric, talk to us about paper, fixed income. You're cautious on emerging market local currency debt. Why so?
Well, look, there have been two challenges in EM fixed income this year. Number one has been supply. With all of the governments around the world increasing their fiscal stimulus and having to issue debt to fund that stimulus, there have been concerns across both DM and EM, but especially in EM, about the amount of debt that would be issued and the weight that that supply would put on the market. The other concern has been, frankly, the uncertainty around inflation, both globally and domestically, and how central banks would respond to that. Now, as we've seen with the Fed, we've seen a major central bank turn a little bit more hawkish recently. As we've seen in some of the other markets around the region, Korea being another interesting example, some of them are starting to tweak their policy slightly in the more hawkish direction. Some of them, however, have remained extremely accommodative. And so I think that's contributed to some of the steepening of yield curves that we've seen.
Okay, we're talking about sovereign paper here. Let me try corporate if we could. A little later this morning, we're going to be talking to a company that essentially goes around buying liabilities, loans, debt off of private commercial banks, bundling them, securitizing them, chopping them up, and selling them on to institutional investors. I mean, this is apparently to sort of fill this funding gap because, I mean, banks since, of course, 08 and the financial crisis have pulled back in terms of infrastructure financing. Does this sound like an appealing, attractive, doable idea that would attract significant demand from institutional investors like, say, pension funds, et cetera, with long-term liabilities?
Well, look, Marty, it's a great question because one of the things that we heard repeatedly, especially 12 months ago, but even at the start of this year, is that credit spreads in public markets were too tight. In other words, investors were not being compensated sufficiently for the risk that they were taking in the corporate space. And interestingly enough, credit spreads continued to narrow. Now, part of that was, the extraordinary amount of liquidity in the system, credit backstops from various central banks, et cetera. But we've seen a continued narrowing of credit spreads. Now, as that's happened, what it's doing is it's forcing investors to look a little bit further and a little bit wider to try and gather incremental yield or to harvest whatever risk premium might be left out there. So we are seeing increased demand for structured credit, for private credit, and we're obviously seeing an effort by financial institutions to try and satisfy that demand. So as long as central banks don't become, excessively hawkish in a short period of time and liquidity remains abundant, which we think it will, we would think demand for that sort of paper would continue.
Oh, okay. Interesting stuff. Eric, always fascinating and valuable talking to you. Thank you for your time and your ideas. Keep safe. We'll do it again soon. Eric Robertsen, Stand Chart